Welcome to the deep dive. Today, we're going to try to tackle FinTech.
Oh, wow.
It's this exciting world of, high-tech financial products and services.
Right.
And we're going to be trying to figure out if it poses a risk to the whole financial system.
Yeah, that's a big one.
For this deep dive,
Yeah.
we're using a 2025 research paper.
Yeah.
It's called Connectedness and Systemic Risk Between FinTech and Traditional Financial Stocks. Implications for Portfolio Diversification.
Wow, that's a mouthful.
It is.
Yeah.
By Irene Henriques and Perry Sidorsky.
Okay.
So think of this deep dive as your crash course on how FinTech interacts with traditional markets.
Gotcha.
Especially when it comes to systemic risk.
All right.
And of course, we'll explore what that means for your own investment choices.
Yeah, that's what everyone wants to know, right?
Right.
Like, how does this affect me?
Exactly.
So it's interesting because we always hear about FinTech's disruptive potential,
Right.
but its impact on systemic risk is a really critical question. After all, just a few rogue waves can potentially sink a very large ship.
Okay, so let's start with the basics.
Right.
What exactly is FinTech?
Yeah.
I know it's a buzzword, but
It is.
what's it actually mean?
Right. So the paper defines it as
Okay.
using advanced technology to create new financial products and services.
Okay.
And this can include things that you probably use every day,
Right?
like mobile payment apps or more complex technologies like blockchain.
Okay.
Even those robo-advisors that are managing some people's investments fall under the FinTech umbrella.
Right, so those robo-advisors,
Yeah.
my mobile banking app, even using Apple Pay at the coffee shop,
Uh-huh.
all FinTech.
All FinTech.
Why is everyone so worried about this systemic risk thing?
Yeah, so the concern is that FinTech is growing really fast,
Mm-hmm.
and maybe even faster than regulation can keep up.
Oh, okay.
So there's this fear that this could create instability that spreads across the entire financial system.
Like a domino effect. One shaky piece knocks down the whole structure.
Yeah, to get a handle on this,
Mm-hmm.
the researchers focused on exchange-traded funds,
Okay.
or ETFs,
Okay.
as a way to represent different parts of the financial sector.
Okay.
They looked at global FinTech, obviously,
Yeah.
but also large U.S. banks, regional U.S. banks, U.S. property and casualty insurance, and global private equity.
So it's like assembling a team of financial all-stars to see how they play together.
That's a great way to put it.
Okay.
The researchers studied the period from September 2016 to January 2024,
Okay.
which, that included some significant market ups and downs.
Mm-hmm.
To analyze how shocks like a big price drop travel through the system, they use something called a TVP-VAR model.
Now, I have to admit, I'm not a finance whiz.
All right.
What is a TVP-VAR model in plain English?
Well, think of it as a way to see how closely connected these financial players are
Okay.
and how those connections change over time.
Mhm.
It helps us understand how a shock in one area, say like a drop in bank stocks,
Right.
might ripple through the system and impact other areas like FinTech or insurance.
So it's a tool to measure how contagious a problem
Yes,
in one part of the market might be.
that's exactly right.
Okay, that makes sense.
Yeah.
What did this model reveal about FinTech? Was it the source of all this potential instability?
Actually, their first big finding was quite surprising.
Yeah.
It turns out large U.S. banks were the biggest source of shocks in the system,
Okay.
while FinTech and insurance were more on the receiving end.
Huh. So the traditional giants were the ones causing the trouble, not the upstart FinTech companies.
That's right.
Hmm.
FinTech, at least at this point in time,
Okay.
doesn't seem to be the systemic risk bogeyman that some feared.
Okay.
The researchers even calculated something called a total connectedness index,
Okay.
or TCI,
Okay.
of 61.36%.
All right.
This means that over 60% of the system's overall volatility comes from how interconnected these different sectors are.
That's a pretty big number.
Yeah.
So if I understand this correctly,
Uh-huh.
big banks are making the waves, and FinTech is more like a surfer trying to ride those waves.
That's a great analogy.
Okay.
But like any surfer, FinTech isn't immune to getting wiped out if the waves get too big.
Right, that makes sense.
Right.
So we've got big banks creating the shocks
Yeah.
and FinTech being more of a shock absorber.
Mm.
What else did the research uncover?
Well, here's the thing.
Oh.
Connectedness, it isn't static.
Okay.
It can spike during crises,
Okay.
and those spikes can be really dramatic.
Gotcha.
Their second big finding was that COVID-19 and the 2023 bank panic
Right.
really shook things up.
Well, those were huge events.
They were.
It seems obvious that they'd have a big impact on the financial world.
Yeah.
What did the research actually show?
For example, in March 2020, When the WHO declared COVID-19 a pandemic,
Hmm.
the connectedness between financial sectors shot up to 77%.
Wow.
That's a huge jump,
Yeah.
showing just how quickly things can change during a crisis.
It's like the entire system is holding its breath, waiting to see what will happen next.
Yeah.
And what about that U.S. bank panic in 2023?
That event also increased systemic risk,
Okay.
though not as dramatically as the pandemic.
Okay.
But it really underscores how vulnerable even a highly developed financial system can be,
Yeah.
especially when confidence starts to erode.
It seems like trust is the real currency,
Right?
even in a world of digital transactions.
Yeah.
When that trust is shaken, everyone feels the aftershocks.
That's a very astute observation.
Oh, thanks.
And here's where it gets even more interesting.
Okay.
While FinTech wasn't the cause of the panic, it was definitely affected by it.
So, even though FinTech wasn't the one holding the match, it still got burned.
Well, that's the nature of interconnectedness.
Yeah.
It creates both opportunities and risks.
Right.
And it highlights why it's so important to understand how these different players in the financial system relate to each other.
You can't just look at FinTech in isolation, right? You have to see how it fits into this bigger, more complex web.
Precisely. And that's what makes this research so valuable.
Right.
It helps us to see those connections and to understand how they can shape our investment decisions.
Speaking of investment decisions, you mentioned earlier that the researchers also looked at how these FinTech traditional finance connections play out in actual portfolios.
Yes.
Can you tell us more about that?
Sure. They compared 4 different portfolio strategies,
Okay.
each with its own approach to allocating investments.
Right.
There's the equal weight strategy,
Mm-hmm.
where every asset gets the same share.
Okay.
And then there's the risk parity strategy, which balances things based on how much risk each asset contributes.
Okay.
They also looked at a variation called risk parity connectedness, which takes into account the connectedness data we've been discussing.
Mm-hmm.
And finally, there's the maximum Sharpe ratio strategy,
Okay.
which aims for the highest return for a given level of risk.
So it's like they're testing different recipes to see which one produces the tastiest and least risky financial dish.
That's a delicious way to think about it.
Thanks.
And as it turns out, the maximum Sharpe ratio strategy emerged as the clear winner.
Okay.
And get this, it loves FinTech.
Wait, the strategy that aims for the highest return while minimizing risk loves FinTech.
It does.
Tell me more.
We'll dive into the details after a quick break.
Okay.
But the key takeaway here is that FinTech's unique characteristics, particularly its low correlation with traditional financial sectors,
Okay.
make it a potentially powerful ingredient in a well-constructed portfolio.
Right, we'll have to hold our breath for just a little longer.
Yes,
Don't go anywhere, folks.
we'll be right back.
When we come back, we'll break down this maximum Sharpe ratio strategy, explore why it seems to have a special connection with FinTech, and discuss what it all means for you in your own investment journey.
Stay tuned.
Welcome back to the deep dive. Before the break, you were teasing us with this maximum Sharpe ratio strategy and its apparent love for FinTech.
Right?
Let's dig into that, but first,
Right.
I'm still kind of curious about how things played out during those turbulent times we discussed earlier, the COVID lockdowns and the bank panic of 2023.
Of course. So let's rewind to early 2020
Okay.
when, the world essentially went virtual overnight.
Yeah.
The research paper highlights how this actually accelerated FinTech adoption.
Oh, okay.
Yeah. People suddenly needed ways to bank, pay bills, and manage their finances from home.
Right. That makes perfect sense.
Yeah.
It was like a real-world stress test for FinTech.
Exactly. And it's passed the test in terms of functionality.
Okay.
But those were uncertain times for everyone,
Right.
including FinTech companies.
Yeah.
They were still relatively new and susceptible to the ripple effects of those shocks coming from the traditional financial players.
So even though FinTech was gaining popularity,
Yeah.
it was still taking its cues from the big banks.
Yes. The data suggests that FinTech was sensitive to those external shocks,
Okay.
especially in late 2020 and early 2021 when there was a lot of uncertainty about the pandemic and the economic recovery.
Mm-hmm. You mentioned earlier that U.S. property and casualty insurance was also generally a shock receiver.
Right.
But I remember you saying that things shifted a bit during this period.
Yeah.
What happened?
Well, think about what was happening at the time.
Okay.
Lockdowns, business closures, lots of disruption.
Right.
All of this led to an increase in property and casualty insurance claims.
Oh, okay.
So suddenly, insurance companies had to pay out more.
Mm-hmm.
which put pressure on their own financial stability.
So instead of just riding the waves, they were starting to create some of their own ripples.
Exactly.
Okay.
It shows that connectedness is dynamic.
Right.
It's not just about who's big and who's small.
Right.
It's also about how specific events can change the relationships between different parts of the system.
Now, what about that bank panic in 2023? How did that shake up the landscape?
So the research shows that systemic risk definitely increased during that period as well.
Okay.
Remember those high-profile bank failures?
Yeah.
They sent shockwaves through the system and reminded everyone just how interconnected the financial world really is.
It's a stark reminder that even in the digital age,
Right.
confidence and trust are still the foundations of the system.
Yeah.
When those crumble, everyone feels the tremors.
Absolutely. And what's fascinating is that even though FinTech wasn't the source of the panic,
Right.
it was still affected by it.
Mm-hmm.
That connectedness works in both directions.
So no one's immune, even if they're not the ones holding the match.
Right.
It seems like this research tells a pretty clear story.
Yeah.
If you want to understand FinTech, you can't just look at it in a vacuum. You have to see how it fits into the larger financial ecosystem.
Precisely. It's all about understanding those relationships,
Okay.
those connections that can transmit both opportunity and risk.
Okay, let's circle back to those portfolio strategies you mentioned.
Right.
You said the maximum Sharpe ratio approach came out on top.
Right.
What made it so successful, especially when it comes to FinTech?
Remember, the maximum Sharpe ratio strategy is all about maximizing returns for a given level of risk.
Right.
What's fascinating here is that this strategy was particularly good at capitalizing on FinTech's unique characteristics.
So it's not just about randomly adding a FinTech ETF to your portfolio.
Right.
You need the right strategy to harness its potential.
That's a great point.
Okay.
The maximum Sharpe ratio strategy works because it recognizes FinTech's low correlation with other sectors, especially large U.S. banks and insurance companies.
Right.
We've talked about how those sectors are more likely to be the source of shocks.
Right. So by including FinTech, the portfolio becomes better diversified
Exactly.
because it's not as exposed to the volatility coming from those traditional players.
Exactly. And that diversification can lead to higher returns with less risk.
Okay.
It's like having a built-in shock absorber for your portfolio.
Okay, so maximum Sharpe ratio gets the gold medal.
Yes. What about those other strategies? Equal weight, risk parity, and risk parity connectedness.
Yeah.
How did they perform?
While they didn't outperform the maximum Sharpe ratio,
Yeah.
their results were surprisingly similar to each other.
So a three-way tie for second place.
You could say that,
Okay.
and that in itself is an important takeaway.
Right.
Even though these strategies were the top performers, they still delivered decent returns with reasonable risk.
So there are multiple ways to build a portfolio that includes FinTech.
Right.
What advice would you give to someone listening who's thinking, okay, I'm sold, I want to add some FinTech to my portfolio?
My first piece of advice is always to do your research.
Okay.
Don't just jump in because it's trendy.
Right.
Understand the different FinTech companies and ETFs out there.
Mhm.
Look into their business models and growth potential.
Don't buy the hype.
Exactly.
Buy the fundamentals.
Exactly.
Okay.
Second, think about your investment strategy.
Are you comfortable with higher volatility? Or are you looking for slower, more stable growth?
Right.
FinTech is still a relatively young sector,
Yeah.
so it can be more volatile than those established financial giants.
Okay.
And finally, don't be afraid to talk to a professional.
Right.
A financial advisor can help you build a portfolio that aligns with your specific goals and risk tolerance. They can be your guide through the complex and ever-changing world of FinTech.
Couldn't have said it better myself.
Yeah,
This has been an incredible journey.
it has.
We've learned so much about FinTech, systemic risk, and how to approach investing in this dynamic sector.
And there's still more to uncover.
Stay tuned, listeners.
Yes.
In our final segment, we'll wrap up our deep dive, highlighting the key takeaways and pondering some thought-provoking questions about the future of FinTech. Welcome back to the deep dive. We've been exploring this kind of intricate relationship between FinTech and the traditional financial system,
Yeah.
uncovering, some surprising insights along the way.
It's been quite a journey,
It has.
hasn't it?
Yeah.
We've learned that, large U.S. banks, not FinTech, are the primary drivers of systemic risk.
Right.
And we've seen how understanding these connections can lead to more robust investment strategies,
Right.
like that maximum Sharpe ratio approach.
Yeah, it seems like the prevailing narrative about FinTech being this, risky, unstable force might need some revising.
Yeah, I think so.
What are some key takeaways our listeners should keep in mind as they navigate the world of finance?
I think the biggest takeaway is that FinTech, at least for now,
Yeah.
is more of a shock absorber than a shock creator.
Okay.
It's being influenced by those waves of
Yeah.
volatility coming from traditional players,
Hmm.
especially those big U.S. banks.
So maybe instead of picturing fintech as a rogue wave about to capsize the ship,
Right.
we should think of it as like a skilled surfer riding those waves.
I love that analogy.
Yeah.
And it highlights the importance of having the right strategy. The maximum Sharpe ratio portfolio, which was best at leveraging FinTech's low correlation with banks and insurance,
Right.
really stood out in terms of risk-adjusted returns.
It seems like diversification is still king.
Yes.
But it's not just about spreading your bets evenly.
Right.
It's about understanding those connections, those relationships between different assets.
That's a crucial point.
Yeah.
And I think it speaks to a broader theme we've been exploring throughout this whole deep dive.
Okay.
The financial world is complex and interconnected.
Right.
What happens in one corner of the market can ripple out and affect everything else.
Like that butterfly effect, but with stock tickers instead of butterflies.
Exactly.
Yeah.
And that's why research like this is so valuable.
Okay.
It helps us to see those connections, understand the dynamics, and ultimately make more informed decisions,
Right.
both as investors and as participants in the broader financial system.
Now, before we wrap up, I have to ask a few, what-if questions.
Sure.
This research gives us a snapshot of the present.
But what about the future? What happens as FinTech continues to evolve and grow?
That's where things get really interesting.
Yeah,
Will fintech always be a shock receiver?
right.
Or could it become a more dominant force, even a shock transmitter, as it matures and gains more influence?
Could the student eventually become the master?
It's definitely possible.
Wow.
And what does that mean for regulation?
Yeah.
Will we see new rules and frameworks designed specifically to address fintech's unique characteristics and potential impact on the system?
And how will investors adapt?
Right.
Will the same portfolio strategies that are successful today still be effective in a world where FinTech is a major player?
These are all fascinating questions.
They are.
And honestly, we don't have all the answers yet.
Yeah.
But that's what makes this field so exciting.
Right.
It's constantly evolving, challenging our assumptions, and forcing us to think in new ways.
It's a deep dive with no end in sight. Exactly. And I encourage all our listeners to continue exploring, to stay curious, and to keep learning about this dynamic and ever-changing world of finance.
Okay.
Who knows what fascinating discoveries await us just around the corner.
Well said. A huge thank you to our listeners for joining us on this deep dive into the world of fintech and systemic risk.
Yes, thank you.
We hope you've surfaced with some valuable insights and a renewed sense of wonder about the complexities of the financial universe.
Absolutely.
Until next time, keep exploring.